opened a custodial account for her son the year he was born, put away birthday money, holiday gifts, a little from every paycheck for 18 years, watching the balance climb slowly and steadily the entire time. By the time he applies to college, it's grown to $35,000, and she's genuinely proud of it. The kind of quiet, disciplined saving that felt like it was doing everything right. Then the financial aid letter comes back lower than she expected, and a financial aid officer explains why. That $35,000, because it's legally her son's money, not hers, got counted at a rate nearly 4 times higher than if the exact same dollars had simply sat in her own name instead. Here's the number that should stop you mid-scroll. On the federal financial aid formula, assets owned by the student get assessed at 20% toward what a family's expected to contribute. Assets owned by the parent get assessed at a maximum of 5.64%. Same money, same amount saved, nearly 4 times the impact on aid eligibility, purely based on whose name is on the account. This isn't a video telling you not to save for your kid's education, and it's not a video suggesting anyone made an obviously foolish decision. It's a video about a specific ownership detail that quietly costs families real financial aid money every single year, one almost nobody explains before the account actually gets opened. Let me show you exactly how the math works. My name is Alex, and today on Wealth Adjacent, we're taking apart the college savings mistake that looks completely responsible and quietly isn't. Quick disclaimer, not financial advice, just an explanation of how federal financial aid formulas currently treat different account types, which can and does change over time as regulations get updated. Let's meet Vanessa. Diligent saver, started early, contributed consistently for nearly 2 decades without ever missing a year. Nobody ever told her that where she put that money would matter as much as how much she put into it. Here's the actual mechanism. The federal financial aid formula calculates something called the Student Aid Index, a number that estimates how much a family can reasonably contribute toward college costs, replacing what used to be called the expected family contribution under an older version of the formula. That number gets built partly from income and partly from reportable assets, and the specific rate those assets get counted at depends entirely on whose name is legally on the account. Here's the part that should make you sit up. A custodial account, commonly known by the acronym UGMA or UTMA, depending on which specific state law it was established under, is legally the child's property the moment it's created, regardless of who opened it, who contributed to it, or who's been managing it the entire time on the child's behalf. Because it's legally the student's asset, it gets assessed at 20% on the federal aid formula, the identical dollar amount sitting in a parent's own name, or in a parent-owned 529 plan specifically, gets assessed at a maximum of 5.64% instead. Run the actual numbers on Vanessa's situation. Her $35,000 custodial account, assessed at 20%, adds $7,000 to her family's expected contribution for that single year alone. The same $35,000, if it had been held in her own name or in a parent-owned 529, would have added, at most, roughly $1,970. That's a difference of over $5,000 in expected family contribution, purely from account ownership, with zero difference in how much was actually saved, how it was invested, or how disciplined the saving habit behind it actually was. Where does this specific rule actually come from? The formula treats a dependent student's own assets as more available for immediate use than a parent's assets, on the theory that parents need to preserve more of their savings for retirement, ongoing bills, and other children, while a student's account is presumed to exist specifically for the purpose it's now being asked to serve, with no other competing claims on it. That logic isn't unreasonable in the abstract, and it does reflect a genuine, defensible policy choice about whose money should be considered more readily available. It just collides directly with how most families actually structured their college savings, often years before anyone explained the distinction. There's a specific pattern worth naming around why custodial accounts got opened this way so often in the first place, since it's rarely a case of anyone making a careless decision. UGMA and UTMA accounts predate 529 plans by decades, and for a long stretch they were simply the standard, well-known option for putting money away for a child, offering modest tax advantages on the earnings along the way that felt genuinely worthwhile at the time. Many families opened these accounts specifically because a bank or a well-meaning relative recommended them, years before financial aid implications ever entered the conversation at all. back when the whole idea of an 18-year-old applying to college still felt impossibly far away. There's a specific complication worth naming honestly too, since it shapes how much flexibility a family actually has once one of these accounts already exists. Once a custodial account is opened, the money legally, permanently belongs to the child. It cannot simply be retitled into a parent's name or converted directly into a 529 plan without first being liquidated, which can trigger real tax consequences on any investment gains, and once the child reaches the age of majority in their state, they gain full legal control over the account, regardless of what anyone originally intended the money for. There's a specific recent change worth naming clearly, since it's genuinely good news buried inside an otherwise frustrating topic. For years, distributions from a grandparent-owned 529 plan counted as untaxed income to the student on the following year's aid application, which could reduce aid eligibility by as much as 50% of the distributed amount, a rule that quietly punished generous grandparents and led many financial planners to recommend timing grandparent contributions carefully around a student's final years of enrollment. Under the Federal Simplification Act, that specific rule changed. Grandparent-owned 529 distributions no longer count as student income on the federal aid formula at all, which meaningfully changes how families might want to structure contributions from extended family going forward. It's worth being precise about what this actually means in practice, since the details matter considerably. A parent-owned 529 plan is reported as a parent asset, assessed at the favorable 5.64% rate. A grandparent-owned 529, historically the riskier option because of the old income rule, no longer carries that specific penalty, though the underlying account still isn't reported as an asset on the student's own FAFSA at all, since it isn't owned by the student or the custodial parent. There's a specific detail worth naming for families applying to private colleges too, since the federal formula isn't the only one that matters, and it's easy to plan entirely around FAFSA while overlooking a second, separate application many selective private schools require. Many private institutions use a separate financial aid application called the CSS profile, which uses its own methodology and can assess custodial accounts even more aggressively, sometimes around 25%, meaningfully higher than even the federal student rate, and often assesses home equity and other assets the federal formula ignores entirely. Families applying primarily to private schools should specifically check whether the CSS profile applies before assuming federal rules are the only ones in play. There's a specific pattern worth naming around families with multiple children too, since it changes the calculation in a way that's easy to overlook when planning saving strategy years in advance. Each child's custodial account is assessed against that specific child's own financial aid application, meaning a family with 3 children and 3 separate custodial accounts faces this exact 20% assessment 3 separate times, once for each child, in each year that child is applying for or receiving aid. A parent-owned 529, by contrast, can often be structured with more flexibility around which child benefits from it, without multiplying the same structural disadvantage across every single account the family holds. There's also a timing detail worth understanding clearly, since it explains why the specific year matters as much as the account type itself. Financial aid formulas typically look at asset values as of a specific date tied to when the application gets filed, which for most families falls during the student's junior year of high school, well before senior year, and well before any acceptance letters have even arrived. That means any restructuring of custodial accounts needs to happen with real lead time, ideally a year or more before that snapshot date, both to allow for a thoughtful, unhurried decision, and to give any capital gains tax consequences from liquidating older custodial holdings room to be planned around properly rather than rushed into during an already stressful application season. So here's the actual check, worth running years before any financial aid application actually gets filed. If a family currently holds custodial UGMA or UTMA accounts intended for college, calculate the realistic financial aid impact honestly. Current balance times 20%, compared against what the same balance would generate at the parent rate. If the gap is meaningful and the account is still years away from being needed, liquidating it and redirecting the proceeds into a parent-owned 529 plan is worth genuinely evaluating, accounting honestly for any capital gains tax triggered by the sale. A few practical moves fall out of that. For families just starting to save, opening a parent-owned 529 plan from the beginning avoids this specific problem entirely, since the funds are never titled in the child's name in the first place. For families with existing custodial accounts, running the math well before junior year of high school, since financial aid applications typically look at asset snapshots from a specific point before the student even enrolls, matters considerably more than trying to restructure anything at the last minute. And for extended family wanting to contribute, understanding that a parent-owned 529 with the parent as account holder, funded by anyone, typically produces a better financial aid outcome than a custodial account opened directly in the child's name. Finally, for anyone genuinely uncertain how their specific numbers shake out, a financial aid estimator calculator, widely available online for free, can model the actual before and after impact using real account balances rather than relying on rough rule of thumb percentages alone. There's a specific parent-side detail worth naming too, since it's easy to assume every parent asset gets treated identically once the general 5.64% figure is understood. Retirement accounts, whether the parents or, in some structures, even ones held on the student's behalf, are excluded from the reportable asset calculation entirely, not assessed at any rate at all. Similarly, the family's primary home generally isn't counted as a reportable asset either. This means the actual list of what counts, and at what rate, involves several distinct categories worth understanding individually, rather than assuming one single rule governs every type of family asset uniformly. It's worth being honest about the other side of this too. Custodial accounts genuinely offer things a 529 doesn't: more flexibility in how the money eventually gets used, since 529 funds carry restrictions and potential penalties if not spent on qualifying education expenses, while custodial account funds become the child's to use however they choose once they reach the age of majority. For a family confident their child won't need significant need-based aid, or who values that flexibility more than the aid formula advantage, keeping money in a custodial account remains a legitimate, reasonable choice. There's an income-based nuance worth naming honestly too, since this entire mechanism matters considerably more for some families than others. Families with income high enough to fall outside need-based aid eligibility, regardless of asset structure, won't see much practical benefit from restructuring accounts, since the underlying aid formula was never going to produce a meaningful award either way. This distinction matters most specifically for middle-income families sitting in the range where asset assessment genuinely swings the final aid number up or down in a way that's noticeable on the actual award letter. There's a psychological pattern worth naming here too, similar to others we've covered on this channel. A custodial account often gets opened specifically because it feels like the more official, more serious choice. A dedicated account, with the child's own name directly on it, compared to a 529 plan that can feel more abstract or less personally tied to that specific child. That emotional preference is understandable, and it's also completely disconnected from which account structure actually produces the better financial outcome once real financial aid formulas get applied years later. Now, let me address the obvious objection directly. Isn't this whole framework just a way to game the system? Shouldn't families with real assets simply report them honestly regardless of which formula treats them more favorably? Worth taking seriously. The formula itself already draws sharp, somewhat arbitrary distinctions between asset types. A retirement account isn't counted at all. A primary home isn't counted. A custodial account is counted heavily. Choosing which legitimate account type to use for already planned savings isn't concealing anything. It's simply understanding rules that already exist and were written with these exact distinctions built in on purpose. There's a second objection worth naming too, since it comes up almost as often as the first one does. Isn't restructuring an existing custodial account just trading one tax bill for a different, smaller aid problem? Doesn't the capital gains tax from liquidating just eat up whatever gets saved on the aid side? Genuinely worth running the actual numbers rather than assuming either direction is automatically correct. For an account with relatively modest investment gains relative to its total value, the aid benefit frequently outweighs the tax cost by a meaningful margin. For an account that's grown substantially and would trigger a large capital gains bill, the math can flip the other way entirely, which is exactly why this deserves an honest, specific calculation for each family's actual numbers, not a blanket rule applied the same way to every situation. There's a specific distinction worth naming clearly too, since it's frequently conflated in conversations about this specific topic. Everything discussed so far applies specifically to need-based financial aid, aid awarded based on a family's demonstrated financial circumstances, merit-based aid, scholarships awarded for academic achievement, athletics, or other talents generally isn't affected by asset ownership at all, since it's evaluated on entirely separate criteria. A family expecting their child to qualify primarily for merit aid rather than need-based aid may find this entire account ownership question considerably less consequential for their specific situation. There's one more advantage worth naming on the 529 side specifically, since it's easy to overlook amid all the aid formula discussion and rarely gets mentioned in the same conversation. A meaningful number of states offer a state income tax deduction or credit for 529 contributions, an additional, immediate benefit that exists entirely separate from the federal financial aid treatment, meaning the case for a parent-owned 529 often stacks multiple advantages on top of each other rather than resting on the aid formula alone. There's a specific alternative strategy worth naming for families who discover this issue too late for a clean restructuring, since liquidation and conversion isn't the only option available. Spending down a custodial account specifically on legitimate expenses for the child's direct benefit before the financial aid snapshot date is a completely legitimate way to reduce a reportable balance without triggering the same tax complications a full liquidation into a different account type might involve. A custodial account can generally be used for things that genuinely benefit the child, certain educational expenses, technology needed for school, even some categories of clothing or activities, provided the spending is genuinely for the child's benefit and properly documented, rather than simply moved into a parent's own use. It's worth being precise about the limits of that spend-down strategy too, since it's easy to overstate what it can actually accomplish. Custodial account funds can't simply be spent on general family expenses or redirected toward a parent's own needs. The money remains legally the child's, and a custodian who uses it inappropriately can face real legal consequences for breaching that fiduciary duty. The spend-down approach works specifically for expenses that were already going to happen anyway. Discovering that a laptop, a testing prep course, or a specific school-related cost can reasonably be paid from the custodial account rather than from the family's regular cash flow, not as an excuse to spend the account down artificially on things the child wouldn't otherwise need. So here's where we land. This isn't about custodial accounts being a mistake in every situation, or 5029 plans being automatically superior for everyone. It's about understanding that account ownership itself is a financial decision with real, calculable consequences, not just a technical detail to sort out later. Vanessa can't fully undo 18 years of custodial contributions without triggering real tax consequences now, but she's planning her younger daughter's college savings entirely differently, opening a parent-owned 529 from year one instead. The point was never that saving diligently for a child's education was the wrong instinct. It's that the specific container that money sits in matters just as much as the discipline it took to save it in the first place. And almost nobody explains that part before the account gets opened, since the person opening a custodial account for a newborn is rarely thinking 18 years ahead to a financial aid formula that didn't even feel relevant yet. Check which name is actually on your child's college savings account, and run the real math before assuming it doesn't matter. If this helped, hit like, subscribe, and tell me in the comments, did you know custodial accounts and parent-owned accounts were treated this differently before watching this video? I'll see you in the very next one.